Good morning, Insignio. Welcome to another Insignio TV series. Today is February 26th. My name is Alejandro Guardiola. I will be your host today. With us, we've got a very special guest. It is Radhika Surie of the Fidelity Global Technology Fund. Welcome to the show.
Thank you very much.
Team, what I thought we would do is start with an overview of the fund. Radhika, can you walk us through just a high-level overview of what the Global Technology Fund is all about?
Absolutely, very happy to do that. So let me start with the basics. I think it's quite important to understand the person behind the product, or I should say the people behind the product. So let me start by introducing you to Hyunho Son, who is the portfolio manager on this strategy. As you'd expect, Hyunho is a very experienced investor. He's been in the industry for over 24 years, and more importantly, he's been on the fund since 2013. So there's quite a long and very successful track record over here. He joined us as an analyst at Fidelity, and he moved to a portfolio manager after that, which means that bottom-up research-based stock selection is very much part and parcel of his DNA. He works very closely with a broad-based team of analysts that we have at Fidelity. So if you look at the slide we have on screen right now, you'll see that we have equity capabilities across the board. So we're looking not just at regional representation, but also subsector representation. So Hyunho works very closely with 31 analysts, many of whom are very, very experienced, and many of whom work very, very closely with him and have done so for years. The nature of the technology sector means that you need to have coverage across very global value chains because your suppliers, your distributors, and your regional developments can have an important implication, as can local technological development, because technology is a truly global universe. Challenges can come up from anywhere, and it's very important to be on top of developments taking place across the ecosystem, which is something that our analysts can provide. They have very strong relationships with companies across the board, but also more importantly, a degree of connectivity amongst themselves, which allows them to have quite a converged view of the sector as a whole, and also keep an eye on what the funding environment is like for early stage technologies, which can often become the technologies of the future. So we do like to keep a very close watch of the entire tech ecosystem with our 31 analysts and with a fund manager who has essentially beaten the peer group by about 81%. When it comes to kind of tenure performance, he's beaten 81% of peers on both a performance basis, but also on a risk-adjusted basis. For a lot of our clients, it has been a very, very great product to be associated with. It allows you to get long-term exposure to the technology sector, where bottom-up stock selection is the crucial driver, and where you stay away from story-driven volatility, because technology is about stories, and every year there's a new story. But essentially, by being quite focused on bottom-up stock selection, often you can get very sound outcomes over a period of time. So that's a little bit about the team that surrounds the product. Now, just moving on very quickly to the philosophical approach, right? Because there are many different ways to invest in the tech sector. And one of the ways that, and many market participants have adopted this way, is to kind of take a very top-down view of themes and the winners of that theme. And, for Hyunho, that's one way of looking at the sector, but it's not his way of looking at the sector, because he is very, very bottom-up focused, which means that for him, company fundamentals are absolutely crucial. He is at any given point in time trying to identify businesses where there is some change happening, where the market has just not understood the scope and nature of that change in exactly the right way. So for him, he's always spending time in the tech ecosystem, talking to businesses, talking to their customers, to their suppliers, to form a 360-degree view of that business. In doing all of that, he is very valuation focused. So one of the key outcomes for this portfolio is that we do have exposure to tech, but we do it in a very valuation conscious way. And we do tend to use sentiment to our advantage. What that means is that if you see a sell off in stocks, if you see volatility overall in the sector, chances are that we will be using the volatility to refresh the portfolio and to find ideas which have been sold off a bit too much. So we are early buyers of stocks. We tend to avoid areas that are expensive, and we tend to avoid areas where there is a lot of momentum, which is not justified. So that's how you need to think about the philosophical approach overall.
That's a refreshing point of view. Can you touch upon anything currently that has taken place with the volatility that we've seen in the beginning of the year?
Yeah, absolutely. Clearly the main development that we've seen sort of January onwards has been developments around DeepSeek, right? Which has had big implications in terms of how the market perceives the winners around AI, the speed and cost of implementation of AI, etc. So that's something we've been paying quite a lot of attention to. I mean, interestingly, the DeepSeek developments have kind of underscored the thesis that the fund manager has had for a long time. His view has been that the known winners of AI in the hardware semiconductor space have had quite stretched valuations, and momentum has been fading over a period of time. We've seen quite a lot of over ordering happening because supplies have been constrained. But his view has been that there are more and more supplies coming on board, which means that to a degree, some amount of demand supply discrepancy that existed will go away over time. So his view has been that as you see technologies develop out, costs go down, efficiency increases, which is good for the deployment of that technology, but maybe less good for the more apparent winners because they lose some of the leadership position that they have. So in the context of the sell-off we saw related to DeepSeek, we have added a position in the hardware semi space, which was previously too expensive. I'm not able to name that right now for disclosure reasons because the trades have been done quite recently. But equally, we believe that this is not a one-shot game. We're likely to see growth diversify across the value chain. So while the market has been fixated on the AI hardware place, we do believe that more of the software and services part of the value chain will benefit going forward because they're able to deploy the technologies at lower cost and higher degrees of effectiveness as this process progresses over time.
Incredible. What could we expect as far as number of holdings in the portfolio and the turnover?
So typically what we tend to see is that there are around 100 holdings in the portfolio. And the kind of 12-month turnover we've seen is about 58%.
Wow. Wow. So very active.
It is an active portfolio, yes.
That's great.
But I think if you have if you have viewers and clients who are worried about tech and tech valuations, one thing I can point out since I'm on this slide is that if you look at the forward PE of the fund, it's about 18.9x, which is much lower than the index average of 26.8x. So we do tend to be quite a value focused portfolio. And we tend to have an anti-momentum bias, which are both important factors to be aware of.
That is very refreshing. 19 times forward PE is less than the S&P itself.
Yeah, it's a very differentiated product because essentially what we're trying to do at any given point is we're trying to invest in many different types of business models, not just in the most apparent winners, but also in areas where you have cyclical opportunities or special situations events, and bringing together different types of investments, some of which have growth characteristics, some of which have cyclical characteristics, and some of which have special sets characteristics, allows you to basically build a portfolio which is essentially quite a core growth portfolio. And that's quite distinct. It's quite different because most of the peer group tends to be much higher up the growth spectrum. But equally, that also means that very often they're paying much higher valuations for that. So the kind of exposure you get from this portfolio is quite distinct.
Radhika, can you walk us through exposure or non-exposure to the Mag 7 names that you had trimmed? Are there any names that are just like glaring, overvalued? Please stay away at all costs.
So, in general, if you think about the portfolio, it's quite different because it is underweight mega caps. It is also significantly underweight the US for the same reasons. We need to think about each stock quite differently because all decisions are made on a bottom up basis. So we have zero exposure to NVIDIA, and we've had zero exposure throughout the generative AI theme. And we have zero exposure to Netflix. Netflix is a relatively new kind of zero exposure because we've had that position. It did well for the portfolio. The thesis over there was about profitability improvement, which came through. And so we've closed that position fairly recently. NVIDIA, fundamentally a good company, but very expensive. We believe that valuations have been stretched for a period of time. And then we have underweight exposures to Apple, where clearly it's a large company. The innovation engine has slowed down. And there's just businesses with a lot more upside in the overall universe, which we prefer to own. Microsoft is quite interesting because fundamentally it's a great business, and we are underweight largely because of valuations. But as the stock has been cheap in the last few months, relatively cheaper, we have been reducing the underweight over there. We do have overweight exposures to Meta, which has basically done a lot of capex spend, but also come up with very, very strong AI functionality and tools, which are helping them build on user engagement and better monetize the properties that they have. And on Alphabet and Amazon, we are overweight because there's both a structural growth opportunity, but also margin improvement opportunity.
Okay, interesting. So outside the US, and it's just a function of your bottoms up work and valuations. Are there any other themes happening that are noteworthy in any country that could rival the US?
When we look at positioning overall, which you can see on the slide over here, it's very, very apparent that the way the fund manager makes his decisions, they're very bottom up in nature. So he's not taking a top down view saying he wants to own more Europe or more emerging markets. It's where he's finding a combination of value and improving fundamentals. So one of the areas where he has added a bit of exposure in the last year or so has been in China, where essentially, companies have been quite attractively valued for a long period of time, but where we are seeing a policy backstop in many ways via stimulus efforts, etc., and where companies have become better run. So capital allocation has improved. They are a lot more shareholder friendly. And in many ways, they have gone through a period of reorganization, which has made them much more effective, well run businesses over time. We also have some plays in China, which are essentially stories related to digitization and semiconductor localization, which is quite important, and some businesses where there are cyclical end markets that might benefit once stimulus comes through. That's the way to think about it. But the actual positions are very bottom up, and this is not a top down view. But in terms of the themes running through the portfolio, I mean, there are several quite interesting themes running through the portfolio. They're all pretty kind of bottom up in how we allocate to them. But let's start with generative AI, because we've taken a very value chain approach to generative AI, and we have held names where we believe there is still upside. And we've avoided names that have been expensive. So while we haven't held, the Nvidias of the world, we have built position in names like TSMC, where they are directly getting orders from NVIDIA, but where there is still upside in the stock name. We've built some positions in semiconductor equipment businesses because the complexity of the manufacturing process is going up over time, and they are likely to benefit from developments around that. A number of cloud providers, they are very well placed to benefit from generative AI because they have large and distinct data sets, for example. And more interestingly, we've invested in data infrastructure companies and IT service companies because what companies are finding overall is to deploy AI in a effective way, you actually need to be able to use it on your internal data sets. And for that to happen, you need all sorts of approvals in terms of governance, in terms of new policies, and also in terms of creating data pools where you actually have data that is searchable, observable, etc. And so we have invested in such businesses, and they are seeing their order bookings related to AI go up. So that's on the AI related names. We've taken quite a broad based approach to the whole space, and we do think it will broaden out even further. We have a number of communication equipment businesses where the thesis over there is that the industry structure has improved. The kind of utilization is also going up because as you think about connectivity of data centers and the need for effectiveness and interconnectivity going up, that comes through. We've talked a little bit about the cloud, but on the more consumer facing side of things, we do have exposure to gaming businesses, to music companies, where I think there are not that many portfolios that have investments in music labels. But if you actually look under the hood, while the market thinks that these businesses are losing pricing power, they're actually seeing an improvement in pricing power. And that's where, looking at stocks on a bottom up basis pays off because you're seeing more and more streaming revenues come through for such businesses. There are new use cases and tie ups to commercialize and monetize the intellectual property of the music labels. So we do have a number of such businesses. Again, on the consumer side, online travel remains quite interesting because experience spend has remained pretty resolute, and there are a number of different types of businesses that are benefiting from that, including some Chinese names like trip.com, etc. More in terms of the European exposure that we have in the portfolio, we have payment names. Obviously, we have known names in the US like Visa, for example. But in the European payment space, we do believe that there's some players that are either best in class in terms of technology, or they are in a good position to consolidate the overall space. So it's pretty broad based. We have quite a lot of exposure. I think we've talked about China. I may not go into that again. But generally, one of the things that Hyunho likes quite a bit is looking at industry structure and where things are improving. So a lot of opportunities are often found in areas where, you've seen some sort of consolidation happen, which means that the share of the pie can be shared by fewer players, and that makes for quite an interesting investment opportunity.
Push back on the 100 holdings. So if there's high conviction names, but having 100 names, how do your best ideas find a way to really generate alpha?
There is no issue with the generating alpha because the way to think about it is you have to think about two things. There's a real barbell in the tech sector, right? You have these very, very large companies on one side. Then you have many, many good businesses which are smaller. And to build a portfolio, you need to take into account of both sides of this barbell, right? Because you also need to think about the index and the fact that you can't own more than 10% in any name. Many of the mega caps are, or sometimes Apple can be up to 20% of the index. So you do need to think about the space as a whole when you're trying to decipher whether 100 holdings make sense or not. And there's no lack of conviction building because if you think about the position in TSMC, for example, it's about a 7% position in the fund. So when there is conviction, that is expressed. And equally, if you think about the underweight in NVIDIA, which is about 14.8% of the index, that is also conviction. That also reflects conviction. So there's no lack of ability to show conviction. The other thing I would say is that we do invest quite differently when it comes to the market cap breakdown of the portfolio. This is quite distinct versus peers. So the sweet spot for the portfolio, as you'll see on the slide, is a sub $50 billion market cap. And this is because, these companies are generally less well covered. They allow you to have more of an active view. Very often, they allow you to find companies on a global basis, which might be ignored by other analysts. And if you choose the right company and there is good intellectual property in the business, that can make for quite a good investment, because there can be cases where they are taken out. So we've done a slide, and you can see this on the screen right now, where every year in this portfolio, you have a few names in the small mid cap space that get taken out. And that's because we're choosing businesses with good intellectual property, in the kind of lower down the market cap spectrum, and that's what having a high number of holdings allows us to do.
Incredible. I mean, look, we're a fan of the mid cap space broadly. That's been a house view for so many months now. So that hits squarely on that theme. We are also advocates of outside the US, just from a valuation standpoint. So that's checking some interesting boxes there. In closing thoughts here, is there a name or two that you want to highlight as as a high conviction name, or as an example of how you've done some of the work to come to the decision to add?
Yeah, if you think about the top conviction positions in the portfolio, you can see them on this slide. We've talked a little bit about Amazon and Alphabet. These are not names that we don't know, so maybe I won't focus on them, but maybe TSMC is a good example to use, because it is one of the larger holdings in the portfolio. And we built this position specifically last year, because we believe that it was a direct beneficiary of generative AI. It's a foundry business, which means that irrespective of who wins the orders for GPUs, etc., doesn't matter if it's NVIDIA or AMD or whoever it is, they will get the orders from most of the players. So they do stand to benefit from that. The stock was relatively attractively valued. They've taken kind of frontline position in high in some types of manufacturing processes, which allows them to deal with the complexity of chip design. And at the same time, some of their main competitors, they're quite weak right now. So if you think about Samsung, if you think about Intel, they're relatively weak, which means that TSMC is able to protect its margins better. And so this is one of the reasons why we do hold this position, and it remains high conviction for us.
Amazing. I know that you could speak to this all day. It was a lot to unpack in a very short amount of time. Thank you for being on the show today. Ladies and gentlemen, this is Radhika Surie with the Fidelity Global Technology Fund. 100 holdings, high active share, good amount of turnover, and playing in space that is not traditionally kind of, within what some of the other peers are doing in their portfolios. Radhika, thank you so much for being on the show with us today.
My pleasure. Thank you for having me.
Insignia Financial Group LLC comprises a number of operating businesses engaged in the offering of brokerage and advisory products and services in various jurisdictions, principally in Latin America. Brokerage products and services are offered through Insignia International Financial Services LLC, headquartered in Puerto Rico, and through Insignia Securities LLC, headquartered in Miami. Both are members of the Financial Industry Regulatory Authority, FINRA, and Securities Investors Protection Corporation, SIPC. Investment advisory products and services are offered through Insignia Advisory Services LLC, an investment advisor registered with the Securities and Exchange Commission. In Uruguay, advisory services are offered through Insignia International Asesores de Inversión Uruguay, SA, Insignia Asesores de Inversión Latam, SRL, and Insignia Asesores de Inversión de Uruguay, SRL, in Argentina, and through Insignia Argentina, SAU, and in Chile through Insignia Asesorías Financieras, SPA. Collectively, these 8 operating businesses make up the Insignia Financial Group. To learn more about the broker-dealers, including their conflicts of interest and compensation practices, please go to https://insignia.com/disclosures/ or via www.finra.org. To To learn about Insignio Advisory Services and any conflicts related to its advisory services, please see its Form ADV and brochure, which can be found at Investment Public Advisor Public Disclosure